Scott, what is a price to earnings or PE ratio as it's often referred to?
Yeah, one of the terms that's thrown around so much in investing, and it's really worth trying to understand. So let's break it down. Price to earnings is, funnily enough, exactly what it says on the tin. Price per share. Earnings per share. If I'm paying $20 for a share and I'm getting $1 in earnings, 20 divided by 1 is a PE of 20 or 20 times earnings. It's a measure of how expensive or cheap that company is relative to the number of earnings you're getting. Now, if I can buy a company for 10 times earnings, if I can pay $10 for $1 of earnings, I'd rather take that than paying $20 for that same $1 of earnings. The cheaper I get the shares for relative to its earnings, the better a deal I'm getting. Now, that doesn't mean cheaper as in price per share, because a $20 company with $1 of earnings is 20 times. A $10 stock feels cheaper, but if there's no profits at all, well, guess what? I'm getting a worse deal than if I buy the company that's a PE of 20. Now, it's not necessarily the be-all and end-all. And the most important thing here is there's companies with no... Amazon, a great example, right? Multi-billion, one of the top 5 most valuable companies in the world, has almost not got a PE at all. And so we need to be very careful in saying you should only buy low PE stocks, which is a value investing approach. That can work for some people. It's not the only way to invest though, but it's designed to give you a look across the market and say, right, what are the more expensive and the cheaper stocks, at least based on that one basis of the earnings itself from the company. So if I've got 2 companies side by side, one's on a PE of 20, that's more expensive, all things being equal, than a company on a PE of 10, which is more expensive than a PE of 5 and so on.
Okay, and one other thing as well is we often hear trailing PE or forward PE.
Yeah.
What's the difference?
Yeah, right. So the trailing applies not to the price, because the price is always today's price, but the earnings. So you can do a PE based on last year's earnings or your expectation of next year's earnings and get 2 very different numbers. So the same company I talked about, $20 a share, earnings of $1 last year, trailing PE of 20, that is 20 times last year's earnings. If those earnings are going to double next year, the forward PE, the forward earnings, all of a sudden that PE drops from a trailing PE of 20 to a forward PE of 10, because 20 divided by 2 in this case, when the earnings double, is a PE of 10. And again, that's why a seemingly expensive company based on last year's numbers can all of a sudden look pretty cheap based on next year's numbers, as long as those earnings come in. And there's always doubt, always uncertainty there. So be a little bit careful with forward PEs, because they can be dressed up based on over-optimistic expectations. But it's always worth, with any investing, looking forwards, not backwards.
So a low PE doesn't necessarily mean you're getting a bargain.
Correct. In fact, some of the worst investments ever have been low PE stocks that have either gone broke or continue to do really, really badly. Some of the best companies over time have had really high PEs and kept on delivering even more. Also, though, the reverse is also not necessarily true. Buying every expensive PE company doesn't guarantee you a good return. As always, we should buy carefully and buy thoughtfully. The PE is just one tool in that toolkit.
Okay, so we shouldn't, I guess, rely on our entire investment thesis on the price to earnings ratio, but more use it as a guidance or a screening tool almost.
Perfectly put.
Excellent. Thanks, Scott.
Thanks, mate.